Welcome to Basic Mortgage Concepts with your host, me, Kane Daniel. In this tutorial, we will be covering the following topics. Number 1, what is a mortgage? Number 2, what is a mortgage broker? Number 3, the mortgage contract. Number 4, mortgage registration documentation. Number 5, why is mortgage financing needed? Number 6, the purposes of using a mortgage. Number 7, conventional and high ratio mortgages. And number 8, collateral mortgages. Introduction. The mortgage market has experienced various changes over the past 2 decades. With the introduction of new mortgage brokering legislation, and more recently with the loss of a few mortgage lenders, the introduction of several new lenders, changes in lenders' guidelines, and the implementation of several new regulatory modifications regarding mortgage financing in Canada, such as alterations of certain default insurance policies. The mortgage brokerage industry has also experienced a variety of changes over the past several years. What was once a small, fringe industry has grown into the mainstream, gathering more acceptance by the consumers as a whole. Although the industry still has a long way to go to achieve the results of our American counterparts, where it was estimated that between 75 and 80% of all mortgage transactions were brokered prior to the mortgage crisis, the Canadian brokerage industry is well on its way. A major reason behind this transformation is the professionalism that both consumers and the industry itself have begun demanding of mortgage brokers. In a complex market where consumer choice for mortgage financing is more diverse than at any other time in history, it has become necessary to upgrade the training available to the industry. As professional students of the mortgage industry, all must endeavor to keep abreast of the innovations in the market. For the new student, or for someone just entering the industry, it is necessary to begin with a firm foundation of knowledge related to mortgage financing in Canada. Section 1. What is a mortgage? According to the Ontario Mortgages Act, the legislation that governs mortgages in Ontario, the word mortgage is defined as any charge on any property for securing money or money's worth. Now, most consumers would not necessarily understand that technical definition. In actuality, a mortgage is evidence of a debt. It is both an interest in land created by the mortgage contract and security for a debt. However, the more common definition of a mortgage states that a mortgage is a loan secured by real property. That is a straightforward, simple definition, but there is more to a mortgage than this. The definition must be broken down into its core components. First, the loan. This is the amount of money advanced to a borrower. Secured. This means that a charge, a legal document that outlines the terms of the loan, is registered on title of the property to secure the loan. If the borrower defaults on the loan, the lender has the right to exercise its interest in the security through several methods. And finally, real property. Real property is the term used to describe the home and the land upon which it resides. It is a legal term that differentiates real estate ownership from other types of property, such as personal property. Personal property is comprised of items that are typically movable property, also often referred to as chattels. Section 2. What is a mortgage broker? A mortgage broker is a practicing professional who assesses a borrower's financial goals with respect to real estate financing, and, after detailed analysis, provides solutions to meet those goals by acting as an intermediary with the appropriate lending source. Let's take a pause for clarification. The term title. Title is a document that reflects ownership of a property, similar to the ownership to your car. It actually refers to the ownership of a bundle of rights that its owner has in a property, typically fee simple ownership. While that's the legal term, it really just means that you own a specific set of rights to use the property, since all land in Canada is actually owned by the Crown. If something is registered on title, it means that it is officially registered against the ownership of the property through the Land Titles Office, where property ownership is recorded. Mortgage brokers have two clients, the borrower, who is the individual receiving the mortgage, and the lender, who is the provider of the mortgage. In order to maintain a healthy market, it is imperative that the broker marry the borrower to the lender best suited for both. In Ontario, the legal distinction between a mortgage broker and a mortgage agent is determined by licensing. Up until July 2008, only a mortgage broker had to be licensed in Ontario, while mortgage agents were registered by their broker with the Financial Services Commission of Ontario. As a matter of interest, the term mortgage agent did not even exist in Ontario legislation until the Mortgage Brokers Act was replaced by the Mortgage Brokerages, Lenders, and Administrators Act 2006. 2006 actually makes up part of the title, and it is not when it was enacted. The role of the mortgage broker revolves around his or her ability to obtain a client and fulfill the financing needs of that client. In essence, the role of the mortgage broker involves selling the right product to the client, and then selling the client to the right lender. Section 3. The Mortgage Contract. We'll start off by talking about the Standard Charge Terms. The Standard Charge Terms is a document that is created by the lender and must be registered with the Director of Titles under the Land Titles Act. This document is the mortgage contract. It contains detailed information on the lender's and borrower's obligations, referred to as covenants, as well as the remedies available to the lender if the borrower does not meet these obligations. A covenant is a promise to do or not to do something. In a mortgage contract, both the mortgagee, who is the lender, and the mortgagor, the borrower, have covenants that each must abide by. The following is a breakdown of both the mortgagor and the mortgagee covenants. Borrower covenants. When a borrower pledges his or her real property as security for a loan by placing a mortgage on that property, he or she has 5 basic obligations. The first is to repay the loan. The borrower agrees to repay the loan based on the payment schedule outlined in the contract. Failure to do so results in the borrower deemed to be in default or in contravention of the terms of the mortgage contract. Number 2, insure the property. The borrower agrees to keep adequate property insurance on the property to protect the lender from losing his or her security due to a fire or other covered risks. If the borrower fails to keep insurance on the property, the lender will consider him or her in default. Number 3, maintain the property. The borrower agrees to keep the property in good sellable condition, including repairing any portion of the property that requires it. Failure to do so will result in the lender considering the borrower to be in default. Number 4, not to commit waste. Waste is a legal term which includes actions or conduct that could result in damage to the property or loss of property value. Committing waste will result in the lender considering the borrower to be in default. Number 5, pay property taxes. The borrower is required to pay his or her property taxes on time. If the borrower doesn't, the lender can pay those taxes, add them to the borrower's mortgage, and/or consider the borrower in default. This is because the municipality can register a lien against the borrower's property for unpaid taxes. This lien will take precedence over any other mortgages registered on title, thereby reducing the lender's security. Number 6, follow the terms of the Standard Charge Terms. It is vital to understand that the borrower, while at the lawyers signing the final documentation to register the mortgage, signs acceptance of the Standard Charge Terms. What many borrowers fail to realize is that they have standard charge terms on their mortgage and that they outline the rights and responsibilities of the borrower. Contravention of the terms of this document is considered default, and the lender can exercise its rights, which the borrower agrees to, that are found in this document. Now let's take a look at the lender covenants. The mortgagee, or lender, also has several covenants by which they must abide. The following list summarizes those covenants. Number 1, a certificate of discharge. Once the mortgagee has received funds that are sufficient to completely repay the outstanding balance of the mortgagee is required to provide the mortgagor, or borrower, with a certificate of discharge that indicates the amount borrowed has been repaid in full. The mortgagee does not have to register this certificate of discharge on title, which means the borrower is responsible for having this registered. If the mortgage is being refinanced by another lender, it is standard procedure for the new lender to have their solicitor closing the mortgage register the certificate of discharge before they register their new charge. The second lender covenant has to do with the assignment of the mortgage. The mortgagor has the right to request that the mortgagee assign the mortgage to a new lender. This is as long as the mortgagor's mortgage is in good standing and the mortgagor has the right to redeem the mortgage. For the exact legislation referring to assignments, refer to the Mortgages Act, Part 1 and Section 2. The third covenant agreed to by the lender is to provide quiet possession. Quiet possession is a legal term that reflects the right of the mortgagor to have possession of the property free from interference by the mortgagee, except, of course, when in default. Section 4. Mortgage Registration Documents. The first document here is the charge or the mortgage. The charge or mortgage is the instrument that is used to register the debt or loan against the borrower's property. This forms the security of the debt. The second document is the discharge of charge or mortgage. This is the instrument used to discharge the debt or loan against the borrower's property. It releases the lender's interest in the property. At this time, we would like you to turn to page 10 to view the case study on Figures 1 and Figures 2. The charge or mortgage is the instrument that is used to register the debt or loan against the borrower's property. This forms the security of the debt. The second is the discharge of charge or mortgage. This is the instrument used to discharge the debt or loan against the borrower's property. This thereby releases the lender's interest in the property. Section 5. Mortgage Ranks. There are different ranks of mortgages, referring to the number of mortgages on the same property. A first mortgage simply means that the mortgage was registered first, or before any other mortgages on the property. A mortgage registered after the first mortgage is called a second mortgage. A mortgage registered after the second mortgage would be considered a third mortgage, and so on. If a borrower who has a first mortgage and second mortgage pays off that first mortgage, the second mortgage would now become the first mortgage. The rank of the mortgage has nothing to do with the amount of the mortgage, but in most cases lenders will not advance the second mortgage that is larger than the first mortgage or that exceeds a maximum percentage of the size of the first mortgage. Typically, the interest rate on a mortgage will increase with the level of risk attached to that mortgage. A second mortgage is considered riskier than the first, a third mortgage riskier than the second, and so on. The reasoning behind this is that if the borrower defaulted on the first mortgage, the first mortgage lender would begin the power of sale process to recover the money owing on its mortgage. Once the property is sold, the remainder of the proceeds of the sale would go to the other mortgage holders, such as second mortgage lenders. This is a risk for the second mortgage lender, since there may not be enough money left for the sale of the property to fully pay off their mortgage. To offset this risk, the second mortgage lender will typically charge a higher interest rate. Section 6. Why is mortgage financing needed? Well, if we look at Ontario, housing costs have risen from an average of $155,000 in 1995 to $360,000 in 2010. This represents an annual increase of 5.78%. So, if a family had wanted to purchase a home in 2010 and had started saving in 1995, it would have had to have saved $15,467 per year. That's assuming a rate of return on their savings of 6% for those 15 years to come up with the full purchase price. This equates to $1,288.92 per month. If you look at the average Canadian family's gross income as of 1995, it was approximately $51,000, or $4,250 per month. The amount that the average family would have to spend to save this amount would be equal to 30% of its gross income. Considering that this family would still be renting and using considerably more of its income, it becomes evident as to why there is such a significant need for mortgages. As it stands, the percentage of shelter-to-income costs, which is the percentage of income that is used to pay for shelter or housing costs, was approximately 21% in 1995. However, if you look at the numbers, they don't add up. It is therefore not plausible for the average Canadian to save the purchase price of a home. Not only is this the case, but also it has become increasingly difficult for individuals to save for a down payment. In fact, the average debt-to-income ratio, which is the amount of debt compared to income, expressed as a percentage, in the average Canadian household, was a staggering 150% in 2010, compared to 105% in 1995 and 55% in 1983. Section 7. The purposes of using a mortgage. Traditionally, there are two distinct purposes for using a mortgage. The first being purchase, and the second refinance, or equity takeout. In regards to a purchase, people use mortgages to assist in purchasing a home in combination with a down payment, or, depending on the financing available, they may qualify to borrow the complete purchase price. A down payment is the amount of money that the purchaser has to give the vendor in cash. The balance of the purchase price is made up of a mortgage. When looking at a refinance or an equity takeout, this is where the borrower already has a home, and he or she may wish to refinance the property. Refinancing means to either increase the size of the mortgage or renegotiate it in some other fashion. If the borrower decides to do this during the term of the mortgage, that person may have to pay a penalty to the lender for repaying the mortgage before the end of the mortgage contract, referred to as the term, unless the mortgage is currently fully open. The refinanced mortgage will reflect the lender's current rate of interest, which may or may not be lower than the borrower's current rate. An equity takeout is when a borrower increases the size of their mortgage or takes out a second mortgage or another debt against the property, such as a line of credit. An ETO is most often used to consolidate higher interest rate debt, such as credit cards. In the case of paying other debts, on closing, the lawyer issues checks to the creditors being paid out from the proceeds. Borrowers may also take equity out of their property to purchase other assets, such as a boat or a cottage, or any other reason as allowed by their lender. Section 8. Conventional and high-ratio mortgages. A mortgage can be described as either conventional or high-ratio. To determine how a mortgage is classified, the loan-to-value of the mortgage must first be calculated. This is calculated by dividing the mortgage amount by the value of the property. A high-ratio mortgage is one that exceeds 80% loan-to-value. This refers to either a purchase where the purchaser has less than 20% for a down payment, or in a refinancing scenario where there is less than 20% equity in the property. If a mortgage is provided by a federally regulated bank, the bank must obtain mortgage default insurance on the loan if the loan exceeds 80% loan-to-value. This is important for us to know because the premium for this default insurance is typically added to the mortgage amount and will increase the mortgage payment. If the mortgage is not provided by a federally regulated bank, then mortgage default insurance is not required. However, many lenders that do not use default insurers refer to their mortgages as self-insured. This simply means that the lender will charge a lender's fee, referred to as a self-insured fee, and is typically similar in amount to a default insurer's fee. The lender will often use these fees to create a reserve fund that can be accessed to help offset losses suffered by a borrower's default. Conventional mortgages. A conventional mortgage is one that is 80% loan-to-value or less. This refers to either a purchase where the purchaser has 20% or more for a down payment, or, in cases of refinancing, where there is more than 20% equity in the property. Section 9. Collateral mortgages. Unlike a standard mortgage that places a charge on title, a collateral mortgage, which has been around for years but typically only used for secured lines of credit, is a promissory note with a lien on the property for the total amount registered. You can register more debt against the property than the property is worth, since normal regulation limitations on loan-to-values do not apply. For example, TD Bank changed their mortgage lending practices on October 18, 2010, changing their mortgages to collateral mortgages. They began registering 125% of the property value, even though that amount may not have been advanced to the borrower initially. Since the collateral mortgage allows for the re-advancing of principal, like a revolving line of credit, the balance can rise. Most charter banks will not allow transfers of collateral mortgages from other charter banks. This results in additional legal fees over and above what are normally charged for a straight transfer on renewal, because the mortgage must be fully discharged as opposed to being simply transferred. In addition, collateral mortgages allow lenders to lend more money to borrowers, based on their qualifications after closing, without registering a new mortgage. This is because the current mortgage is registered at a higher amount than is advanced. The rate can also be increased because the rate on the collateral mortgage is also registered at a higher amount than is charged. For example, a bank can register a mortgage at 125% of the value of the home and at prime plus 10%, but may only advance 80% of the value of the home and charge prime at the time of closing. This allows for both additional advances of principal and increases in the rate during the life of the mortgage. Since the mortgage is registered for such a high loan-to-value, the homeowner won't be able to take out a second mortgage, regardless of how low the outstanding balance is on the first mortgage. While this type of situation allows for the homeowner to borrow more funds after closing without having to discharge a current mortgage and register a new one, it also comes with the previously mentioned risk, making it important to explain this to the borrower when arranging this type of product. And that brings us to the end of this tutorial. Please ensure that you read the chapter and that you complete the chapter review questions.